Let's kick off this morning with Nadia Wiggen, a director at Svelland Capital. Nadia, sitting in Norway, your thoughts on whether this agreement, the fact that obviously the Chinese and the US went into these talks in London, it would appear with most of the I's dotted and T's crossed, that this will be enough now to propel Brent crude oil up to the holy grail again of $70 a barrel. Your thoughts?
Good morning. Well, we don't have the details yet on how these trade talks have progressed. And for the oil market, it matters a lot what is the general framework and tone, as well as a willingness to create exemptions and exceptions. And what we've seen with the whole trade balance is, of course, oil, LNG, LPG. These are the ways that China can improve that trade balance. So the oil market really wants to see progress there. So far, we have ethane, which is exempted from the tariffs on the Chinese side. We would love to see other US oil products to be included in that.
The idea that oil markets, Nadia, are range bound. There's nothing. Despite the swing we saw, Brent dipping below 60 and now trying to knock on the door of 67. That is it your sense too that we are range bound, that these are not dramatic enough events, i.e. U.S. peace agreement, U.S. trade agreement with China, maybe it's peace as well, we'll see, but that these events are not sufficient to propel it into a new sort of paradigm?
Well, we have been, as you say, in a very tight range. And right now, we don't have enough detail, I think, on the China-US progress for the market to truly assess this change. I mean, since Trump
I suppose ultimately
elected,
it doesn't change.
it's been quite a negative range and feeling with these additional tariffs and the general positioning in the oil market. When you look at speculative positioning on the bulls versus the bears, has been tilted towards the bearish side, and algorithmic traders, except for the very short-term traders, keep receiving sell signals based on where we are in terms of price movements. We've broken through the 50-day moving average, so your very short-term algorithmic traders have received a positive signal, so they can be more on the buying side, but it's not enough to completely change the fundamentals and that feeling. And this is when we look at the shipping market, it's another indicator of where the market has been short since the Trump election and continued to be because of concerns over tariffs. Now, when we see that really make a seismic shift to the bullish side, then we know that the market has decided the worst is behind us and we have clarity on these tariffs that we can continue going forward. In the meantime, however, actual oil demand has been very strong, and that's been led by strength in Europe, relative to the expectations that the market had in the second half of last year when we started that downtrend. The expectations were that we were going to have massive stock builds. And we're still in a pretty low, historically driven inventory situation, especially on the crude side. Japan is built in the last week, but they have 900,000 barrels per day of refinery maintenance right now, including outages, unplanned outages. But overall, we're in a strong situation in terms of low inventories going into peak demand season at a time when OPEC has already 3 times announced that they're going to do much faster than expected cuts. And we've yet to see a single barrel of that oil hit the water and be visible beyond the cheating that we've seen from the countries for the last 6 months.
Nadia, one thing you can't disagree with is the fact that the World Bank came out yesterday with their mid-year report and downgraded global economic growth to just 2.3%, the lowest since the global financial crisis to 2025, putting aside the dramas of COVID. Yet the oil markets didn't even respond. I mean, they stopped going up maybe, but ultimately, world economic growth down to 2.3%, worse since the world financial crisis, and oil markets don't react. Your thoughts, A, on the World Bank report, B, on the lack of reaction?
I think the World Bank is reflecting what the market already thought. We have the price response. So they had already expected a much lower, slower number, and the World Bank is catching up to what the markets had already priced in. And of course, we have to remember that oil markets, they trade month to month. And right now, refinery margins are great. The market is clearing. It's tight on the sour side. We have a lot, we have Canadian outages and forest fires. We have Venezuelan oil that is increasingly going to be tough to load, given that Trump did not extend, the freedoms to continue pushing that. We have concerns about Iran because that agreement has not been signed. The latest I've seen is that the Iranians are not happy with the terms. So there is a lot more uncertainty. And I think the biggest one to me is the fact that when we think about a potential price war with OPEC, a part of that is Saudi Arabia, that yes, we are hitting peak demand and exports and parts of that. But in our view, Russia's sitting on 500,000 barrels per day of spare capacity. So a real volume price war led by OPEC would depend on an increase in Russian exports. And right now we have the EU proposing that the price cap be brought down to below to $45 a barrel from 60. Let's see if that actually holds water. But that would make things much tougher economically for Russia to ramp up. Historically, yes, they have the lowest cost of production. We thought until the COVID price war, when we saw that Saudi Arabia was the last producer standing, not Russia. And so that is a big difference. Saudi Arabia, of course, could do this themselves, but the Gulf producers have really maintained that that partnership with Russia is very important. So right now it's looking more like a tepid, let's put in some more barrels officially. Let's see if the price holds. Well, it's holding. It's going up. So we're clearly doing the right thing at a time when some, as Gaurav says, some marginal producers in the US are already getting hit. And most importantly, next year's production is in question for the US. And that's where we have production declining the second half of next year. And then, OPEC may not need to cut as drastically as the market has been expecting. So things are
You
going more slowly and more orderly.